Hello everybody. So as promised, this is my video on space stocks, and there are 5 space stocks that I want to look at today, and I have all run them through my valuation spreadsheet, and the only one that somehow, some way fits somewhat in my spreadsheet but doesn't really look cheap, it looks quite expensive. That one stock is RocketLab, and RocketLab, let me just put a disclaimer out there. I actually own a Leap on RocketLab that I had bought when that rocket that failed. Was it about a year ago? Yeah, it was. I think it was like 13 or 14 months ago. One of the rocket that crashed, and the stock had gotten into the $3 range, and I had gotten a single Leap on it. Just took a gamble, and we'll see in 2026 what I do if I exercise that Leap or not. But the Leap is well in the money now. So I have some exposure to RocketLab. I liked it the first time I had looked at it, actually, and I still like it. I'm beginning to like it a little more, but the problem is it's a whole lot of new knowledge that I have to acquire in order to be able to properly analyze a space stock. So that's why I'm just going to stick to the financials. And when I look at the financials of RocketLab, well, first of all, I'm very satisfied with that revenue growth of 41%, which is a diversified revenue growth. They have multiple customers. They have multiple systems, right? They not only have some launch revenue, but they also have space systems revenue. So they have multiple sources of revenue. They're a supplier as well as a launch provider. They specialize in low Earth orbit. They've had some lasting power. They've lasted in the space quite a bit, and a famous VC in the name of Vinod Khosla is behind RocketLab and actually invests heavily in that company. So while all of your companies don't really have the blessing, well, they may, but maybe not as prominent of a person as Khosla, for example, this one has the blessing of Khosla Ventures, which is why it led me to took the leap and buy the leaps, right? Buy the leap on it, the leaps on it. But the point is here that I'm trying to make is the revenue growth predicted to be at 41%. It looks like as long as they don't fail these launches, they're going to have more and more growth, and this can last a very long time. They could be a credible alternative for low orbit satellites, a credible alternative to SpaceX. Keep in mind, they're number 2 in the space. I don't like investing in number 2s in the spaces, in any space, but the problem is that SpaceX is not public. That's problem number 1, and we don't know when it will be public. It's kind of a best play in the space. Like if you want to be invested in that space, and as I study that space, I find RocketLab to be the best play in that space. Anyways, really briefly, so for Q3, they're predicting $205 million in revenue, which is excellent. I'm wondering if I calculated that right. I think I did. So that's an excellent amount of revenue. And they're expecting a loss of 32 million, right? I take the middle point. They're expecting a loss of 32 million. So what does that tell you? That their EBITDA margin is minus 15%. That's what they guided for the next quarter. So it's much better than the trailing 12-month EBITDA margin at minus 43%. So they're still bleeding cash, but bleeding 32 million in a quarter as they give us in the guidance. That's much more manageable. You have a better runway. So they have 497 million on the balance sheet. So that's 16 quarters or 4 years of quote-unquote loss runway. So they can lose money for 4 years. And of course, the hope is they're going to get some operating leverage as the revenue keeps growing, and they're actually going to get EBITDA profitable, and then maybe one day GAAP profitable, and that's when the stock explodes, right? That's typically how it works. I think they'll make it. I think this Leaps contract will turn out to have been a good investment for me. But right now I don't have time to dedicate to studying this company. So unfortunately, I'm not adding to this stock, but it's the only stock in there that I like. It's the only stock in there that I like. That's it. I spoiled the video. I guess if you want to know why, let me keep going. So space. Oh, it is really rare that we get a negative enterprise value. Wall Street is paying you to own this stock, and so you could say theoretically, if you buy the stock at a negative enterprise value and it goes bankrupt tomorrow and pays everything off, theoretically there's money left over for shareholders, but that's theoretical. I don't think they're going to file bankruptcy. I think they're going to keep going and keep losing the money and sinking the money into the project, because space, that's Virgin Galactic, if you're not familiar, right? Virgin Galactic is the name of this company. It's the child of Richard Branson. That's his baby. That's his company. So he's gonna keep pouring money into it, in my view. And I wouldn't touch this one. I would not be interested in this one. Note that you could have weird arrangements where the company goes bankrupt and then Richard Branson goes to the bankruptcy court with his own money and is like, yeah, okay, I'm gonna buy the company, and then the judge is like, yeah, okay, I choose you and you can get the company back. Things like that have happened in the past, so I wouldn't put it out of reach that it's what could happen. I just want to point out that unfortunately the track record of Virgin in the space race is not that good, because Virgin Orbit also filed for bankruptcy. Now I want to point out, whether it is Virgin Orbit or whether it is Virgin Galactic, the interest rate environment has absolutely not helped these companies. These companies went public at a time when Jay Powell was saying, we're not thinking about raising rates. And think about that. These are companies that are going after space, one of the most capital intensive projects you could ever go after. And so, of course, the interest rate environment played a major role in the bankruptcy of Virgin Orbit. And if bankruptcy comes for space, it will have played a major role, in my own opinion, because the plan initially for a company like Space, and I remember the IPO of that company, the plan was necessarily to raise more funds as the value of the stock goes up, because we were going to have a zero interest rate environment. This is a type of company that has been entirely killed by the interest rate environment. In fact, I happen to believe it's kind of a miracle that RocketLab makes it. It's a miracle. So let me move on to another company here, which is ASTS, and this company is Space Cell Phone Service. Space Mobile is the name of the company. They are building the first cellular broadband network, and they launched 5 satellites, and the market got really excited, and the stock did a 7x. I mean, I can't say I understand how. I mean, good for you if you own the stock, 9 months ago. That was really good for you, because that was a 7x. But as far as explaining this through numbers and through my habit and my framework of analyzing stocks, I just can't explain that one, because when I was reading the document, for them to have a commercializable service, for them to start making money from the service, they need 90 satellites. So they need 90 satellites. So if you read about it online, they say, oh, well, they may commercialize the space cell phone company, right? The cell phone service in space. They may commercialize it in 2027 or 2026. You think SpaceX will not have turned on something by then? I think that's a very risky bet to take for 2 reasons. One is we know that SpaceX is partnered with T-Mobile. SpaceX is partnered with T-Mobile, with Starlink, and so eventually and this is from May 24, right? So this is fairly recent stuff here. Eventually, there may be a partnership with SpaceX and T-Mobile, or just SpaceX go it alone, and they will capture that market for themselves. They will be the cell phone provider for themselves. I doubt that they will just not do it. They will do it. So again, you're playing with a number 2 in the field of space cell phone service. This is a number 2. Another thing that I absolutely don't like. There's 2 more things that I don't like, actually. So that was the first thing I don't like. SpaceX, I think, is going to launch their own cell phone service. Second thing I don't like is the backing of AT&T and Verizon. I don't understand it. I really don't. These are bloated companies that are riddled with debt, who are just taking a real option by placing a little money into something that could potentially prevent them from being disrupted. You know, this feels like Volkswagen putting $5 billion into Rivian because someone in the company is an advocate of that idea and is saying, hey, you know, there's disruption coming. We might want to put our chips in, right? Or GM back in the day putting money into Lyft. You may remember that. To me, this is not very, very serious. And the company, of course, the valuation of this company went up quite a bit because of the partnerships, right? Because of this. And the last thing I'll say is, guess who launches these satellites? The 5 satellites were launched by SpaceX. So your competitor is also launching your product. I don't like that. I don't like that because it's like you're sponsoring SpaceX in a way. You're sponsoring your competitor. So I don't like that. You know, I think it would be wiser if they actually used RocketLab to launch their service. But in my view, and of course, let me not even get started. You know, there's no margin. Right, there's no revenue to speak of. I mean, the valuation EV over forward revenue, it's meaningless at this point, right? It's 630. But these companies are. I am not equipped to analyze most of these companies. It's too early. It's too early. It's much closer to VC investing. It's much closer to the style of investing that say Cathie Woods have, right? Cathie Woods, ARK Invest, they will look at these stocks because they invest earlier in the stage of development of these businesses than I do. I like to invest in businesses that are more mature but are less risky. So, anyways, to me, I would stay away of that one. You know, but kudos to those who bought it when it was 7 times cheaper. That's for sure. Okay, now Redwire. Let's talk about Redwire. And I want to say, my viewers, you recommended this one. I can't remember who it was, but thank you for recommending it. You got my attention with this one. There's a lot of things I like about this one, and you can see on my spreadsheet is actually 0.35. I mean, for the field of space, which is, I mean, let's face it, it's one of the most hyped up sector in the field of investing. Actually, it's one of the most hyped up sector, period. People love space. They have, you know, for maybe centuries, they love space. So the valuation I don't expect to be cheap in that sector. But this one, you caught my attention because they're a supplier to space agencies and the space station and to people running experiments. They have a diversified revenue, multiple customers. The customers need to be thought of, in my view, when I look at this company, they need to be thought of as bids and how many bids they place on how many tiny little project. And then if they get the project, right, that's something that they can sell. They are building infrastructure in space, and they have some satellite infrastructure, they have some solar panel infrastructure, and they have equipment for the space station. And I was particularly impressed when I was looking at their pharmaceutical and manufacturing in space division. I kind of follow that space. I'm a little passionate about the space of genetics and health and pharma. You know, and there's gonna be things in the field of pharma that are gonna need to be manufactured in space, because when you 3D print something, say a heart, or when you 3D print a cell, it behaves entirely differently and it behaves more favorably when it is manufactured in space. So I really like that side business of them. There's a lot of hot industries that they touch by being this supplier. Unfortunately, in my view, they're cutting it way too close to bankruptcy for comfort for me. And of course, they wouldn't go bankrupt. They would borrow money, etc. But they're cutting it way too close. No, so adjusted EBITDA usually tracks pretty well with the cash flow. But in this case, I overlooked kind of the cash flow for investment. Just look at cash flow from operations. So it's a minus 9.5 million, right? And they have 30 million of cash in left. So that's 3/4. So you're cutting it close at the run out of money. And of course, if you go in the investor presentation, they're quick to show you, look, our liquidity is 58.2 55.8 million, right? But then you got to go there and see its borrowing capacity, right? It's available borrowing capacity, right? It's kind of like borrowing against your house. You have a lot of liquidity. You think you can borrow a lot of against your house, but then you're putting yourself, deeper into debt. So do we want this company to put itself into debt in order to be able to survive? Well, yeah, and even then, that would just be a year and a half. So this company needs to stop bleeding cash. As small as it may seem, that $10 million is, as small as it may seem, it needs to stop bleeding cash. And I think it's possible because they're growing at 31%. But to me, that's cutting it way too close. It's a stock, though, that I'm open to reanalyzing when those numbers get better, and we'll see where valuation is at today. Again, the valuation for many of these, aside from Space, obviously, from Virgin, but for many of these, the valuation is quite high. I mean, look at the valuation for RocketLab, right? I like RocketLab. I think it's a great project, but at this valuation, I mean, you can get some premium companies at this valuation. So the last company, which of course I'm out on this one, it is Lunar. And Lunar was a company that made the buzz because they win a bid from NASA. And these bids, how they work. Once you win the bid, you unlock the funds. And as you unlock the funds, as you go through the milestone, so the revenue gets recognized. But nonetheless, this is as single customer as it gets. I mean, sure, they have they have some commercial payloads, but to me this is mostly a play of a company trying to sell to NASA for the lunar business, right? You can see they're working on this program for, say, a lunar terrain vehicle, and they won that contract. So it's good for them, but nonetheless, it's too risky to me. It's too risky. It's too dependent on contracts, too dependent on all of that sort of stuff. So I would stay out of this one. Although it's true that it was a trendy stock. I remember, was it 6 or 7 months back when they won that contract? People were really excited about it. And this is, I guess, what I'll conclude with is all of these companies, they trade a lot on, I hate to say hype, but they do trade a lot on hype. And this is where I think the ARKX ETF from Cathie Wood, the space ETF of Cathie Wood, may be interesting too. And you could hold it for a long time. And let's assume, say, there's a huge interest in space because there's a new lunar mission. The one they're planning with SpaceX, and everybody's interested in space. And we see the lunar lander, and they land people on the moon again. Let's say it's 2027, 2028. I could easily see the stocks in the space entirely skyrocket, and then that would be maybe an opportunity to sell them, right? Or imagine if we go to Mars. Imagine how these stocks would skyrocket. This is almost something I'm going to call deep long-term investing. Let's call it that. It's deep long-term investing. I mean, this is almost the type of long-term investing where it may only make sense to invest in this type of stocks if you're in your 20s, right? I'm in my 30s. It makes sense too for your 30s, you know what I mean? But it's like it's so long-tailed. It is so long-tailed, right? RocketLab, what is it? What's the name of that company? Redwire, all of these companies, infrastructure in space, manufacturing in space. Let's take manufacturing in space. Well, when will manufacturing in space happen? At scale, I mean, at a meaningful scale. Will it be in the 2030s, in the 2040s? That's a lot of time. And that's a lot of disruption potential that cannot be foreseen. And that's also a lot of time for SpaceX to keep growing like a weed as well. So because of that, I find these stocks risky. I'm happy with RocketLab because they're operating. I'm not entering any of these other ones. And of course, as always, this channel is no investment advice. This video was not investment advice, no financial advice, as always. This is just entertainment. I hope you were entertained. Please like, please subscribe. Thank you for watching, and have a wonderful day.